Thank you very much, Director of Ceremonies. I have a confession to make today. You know, Standard Bank has been very nice to me historically. When I'm looking for money, they are there. When I'm looking for a bank to lead a transaction, when we are going to the market, they are there. And they do a good job. But today, they have made my work so difficult. In the morning, they brought me here after the minister. And who wants to listen to you after they have listened to the minister? Then this afternoon, they are bringing me after the prime minister. Surely, is, is that the deal that I called for? I'm hoping that next time when we meet, you will do what we have always done with you. You be nice to me. But thank you very much, ladies and gentlemen. This will be very, very brief. And the PowerPoint you are seeing there is just to make sure your attention is drawn to the screen. It is simply a placeholder. So I will not go through it slide by slide. I'll be skipping them and simply talking of the key issues that I think we need to look through as a team. And then if you have any questions, then definitely we can have a chat after that. Now, Kenya boasts of a very highly diversified economy. While we have agriculture still playing a very, very prominent role, contributing more than 20% of GDP, we've got the service sector having grown to the point that it is a key support to the Kenyan economy. Now, there are several achievements that we have had in the recent past. As you see on the bottom left, Kenya continues to make significant advancements in the services sector. It was ranked first in Africa in 2022 as Open Data by Open Data Barometer from the World Wide Web Foundation. Now, secondly, it was ranked 8th in Sub-Saharan Africa in 2023 by Global Innovation Index. And then it was ranked 4th in Africa in 2024 by Network Readiness Index. So we have got a country that is dynamic, diversified, and seems to do fairly well on a number of measures that you may want to look at to measure the performance of the economy. Now, how are we doing in terms of growth? Now, the economy has been very resilient. Even in 2020, when a number of economies contracted, our economy contracted by just 0.3%. Many economies in Africa and globally contracted by big margins, but we contracted by only 0.3%. And thereafter, of course, as was happening in many other economies, we have seen a big rebound, and the economy has been growing by more than 4%. In 2023, we recorded a growth of 5.6%. In 2024, we had a slowdown, but to the point that our estimated growth for 2024 is still far higher than what you see in Sub-Saharan Africa. We estimate the economy grew by 4.6%, and we expect a major rebound this year to a growth of about 5.4% in 2025. And we think that is quite reasonable. Of course, within East Africa, I think our economies are performing very well. As indicated by the Deputy Governor in the morning, Tanzania is actually able to grow despite the constraints that we face as a region by more than 5%. So EAC as a region is doing very well in terms of growth at the moment. Now, inflation. We have been able to contain inflation successfully. In October 2022, the number is not there, our inflation was 9.6. That is the peak of the recent past. Now, this has been tamed to the point that we came down to 2.7% in October 2024, but it rose slightly to 3% by December. Our reading for February was 3.5%, and that is basically just because of the seasonal factors on inflation, things to do with food, the seasonality of the prices of food, which are temporary. If you look at the core inflation, it is at 2%, which tells you that the monetary policy has managed to effectively contain inflation to the required levels. Now, unemployment, if you look at unemployment, we are in a fairly good region comparing to what is happening in Africa in general, unemployment of 5.6%, which is way below several countries within our region. Of course, you are seeing some neighboring countries also doing fairly well on that measure. Now, then, I'll skip that, or I'll not talk too much about it, but in terms of the climate agenda, I think Kenya has taken a significant lead, and we are making a lot of progress on clean energy transition. Kenya is one country in Africa that has more than 90% in renewable energy. I think that is a feat that very few countries have, even the developed world. So we are doing fairly well as far as green energy transition is concerned. Now, how are we doing in terms of fiscal? Now, we have serious fiscal constraints. Of course, we are currently pursuing a fiscal consolidation plan where we aim to reduce the fiscal deficit gradually because of the debt vulnerabilities that we have. So we have a plan to reduce the deficit to fairly low levels, to the levels that we have agreed as part of the EAC to go through a convergence of the economies, or the macroeconomies. So we moved from 8.2% in 2020-21 to 5.3% in 2023-24, and we estimate that this year we are likely to have a budget deficit of no more than 4.9%. Now, this has been driven by measures to increase revenue collection, but also to rationalize expenditure so that we achieve the consolidation through not only driving expenditure rationalization, but also mobilizing additional revenue. We were so aggressive in revenue mobilization to the extent that the young people felt this is too much, and they went to the streets, and we had to throw out a finance bill with new revenue measures last July. That was a big setback, but it was also a big lesson to us in terms of how much can you push people to pay your taxes. And therefore, we have learned that going ahead, the focus should not be on tax rates, but the focus should be on widening the tax base and, where feasible, reducing the tax rates so that you rely on the volume of consumption and the number of people paying taxes rather than on the tax rates. Now, then going forward, we are implementing several reforms to drive the revenue mobilization, and we are implementing several reforms to drive expenditure rationalization. And we have those very clearly outlined, and I believe those of you who will be able to get the slides will be able to see them. This is no longer, oh, sorry, yeah, that's okay. In terms of the budget deficit, as I've indicated, we are planning to have, this is an earlier figure, the latest figure that was approved that I think is ready as of this week. We are planning to have a deficit of 4.9% of GDP, and that is going to be financed from both domestic borrowing and external financing. all of which we have identified where that is coming from. In fact, for domestic borrowing, our target for this year is already met. So because of the deep domestic debt market that we have, we are able to generate enough borrowing that we need to meet the domestic borrowing target. Now, where is the funding going to come from? As I've indicated, domestic financing, but also foreign financing from the commercial loan window, project loan, program loans. But of course, we also have concessional borrowing window through the African Development Bank. We have the IMF and development policy operation from the World Bank. So those will be our main sources of borrowing this year. Just coming to an end. Then we still have debt vulnerabilities, but the ratios are improving. In December 2023, our debt to GDP ratio was 72.8%. That has come down to 65. Actually, by end of December 2024, it is down to around 64, which is the direction we want to go, because the target, the anchor for debt is 55% of GDP. The present value of debt to GDP ratio that we have in law at the moment that we need to move towards is 55%. And that is what we are heading towards, and that is why you see that ratio continuing. I've already talked briefly about the domestic debt markets, and I don't want to repeat that. So then where are we heading to? Now, in terms of, those are the ratios that you can look through in the slide. As we go forward, we expect to continue addressing the debt vulnerabilities through the liability management operations. Some of you participated in our liability management operation that we carried out in February, and we are very grateful. And this is basically meant to ensure that the debt vulnerabilities that we have at the moment are addressed and eliminated, so that going forward, we do not have any challenges that we have had in the past. Our monetary policy continues to support the policy of the government and is always responding to the needs of the economy to make sure that whatever is being done is supportive of our growth-enhancing policies and is supportive of the fiscal objectives that we also have. Now, in terms of the banking sector, it remains very strong and well capitalized. And of course, their credit risks are elevated at the moment, but it's something that we think is temporary, and going forward, that should improve drastically. The other measures of the macro performance have been very good, narrowing current account deficit to the point that last year we had about 3.7% of GDP, which we think is reasonable, and going forward, we expect it to remain at almost the same level. We have had fairly drastic accumulation of reserves purchased from the interbank market, and this is because of the strong exports we saw last year, is because of the strong remittances that we have seen over the years and even last year, strong earnings from tourism that have been able to bring in forex into the market that the central bank was able to purchase to accumulate reserves. So thank you very much, ladies and gentlemen. I'm going to stop there, but we are having a lengthy discussion tomorrow where I hope I can be able to do a lot of questions and answers. Thank you.